Hello, everyone, and welcome to today's webinar. My name is Lucy Heavens, and I'm VP of Marketing at Hokodo. So over the next 30 minutes, we're going to be looking at the importance of payments within trade credit. So this is part of a series of 6 webinars where we're going to unpack the whole end-to-end trade credit process. So a couple of quick housekeeping items before we start. Firstly, the format for today's webinar is a panel discussion. So I'm going to be having a very informative chat with my expert here today. I hope it's informative. And we've allowed plenty of time for questions. So please feel free to type them in and we will bring them into the conversation. And then lastly, a recorded version of this webinar will be available and sent directly to your inbox after we've finished. So to set the scene a little bit here, trade credit, which is also known as B2B Buy Now Pay Later, or BNPL, is a form of credit that's offered by B2B sellers to their customers, to their business buyers. So because B2B purchases tend to be higher in value than the B2C world, arranging payment terms can be beneficial to businesses, and it helps them to keep a close eye on their cash flow. And trade credit is a huge market. According to the World Trade Organization, about 80 to 90% of trade worldwide is facilitated by trade credit. So offering buyers the option to pay over an extended period of time, say 30, 60, 90 days, it sounds relatively simple, but there is a lot of complex processes and flow of payments behind the scenes, which is what we're going to unpack today. And luckily, I have an expert here to help me out with that. So Louis, would you like to introduce yourself?
Yeah, good afternoon, everyone, and thanks a lot, Lucy. So my name is Louis Carbonnier. I'm the co-founder and co-CEO at Hokodo. We're a specialist in B2B payments, and in particular in the buy now, pay later part of B2B payments, i.e. trade credit, as we called it in the old days. And what we do in particular is we empower B2B merchants to offer payment terms to their professional customers so that they can, transact more easily on their platforms. And in particular, we do this very well in the context of online transactions.
Thank you. You're hired. Thank you very much. So as I mentioned, there is kind of this complicated, flow of payments that happens kind of in the back end of this trade credit process. So, can we talk about that? Can you tell me a little bit about what's happening between the seller and the buyer?
Yeah. So when you have trade credit traditionally, whether it's, pay now or pay later in the context of a B2B transaction, well, the traditional flow would be that the buyer, the customer, pays the merchant either upfront if it's pay now, or on 30-day terms, 30 days end of month, which would be often the norm in B2B. And that flow, once you start using a digital provider like Hokodo, will be slightly modified. And the reason why companies like Hokodo exist is that this trade credit management has happened for decades, if not centuries, offline, but it's very hard to bring into e-commerce. And that's where we come in and support the merchants and the marketplaces. And concretely, so back to your question, what changes in the flow of payments? Well, it always starts with a transaction, just like in the old world, where a customer comes onto the merchant's website, for instance, makes a purchase. The transaction is sealed and agreed at that point. And when it becomes a bit different is that the buyer at this point gets, let's say, 60 days to pay. That's agreed. And then Hokodo will actually pay the merchant upfront. The merchant can choose when they want to get paid. Is it immediately after the transaction, a couple of weeks later, just on due date? But essentially, Hokodo will be advancing the funds to the merchant, which in a way changes the flow, because it's no longer the buyer paying directly the merchant. And then Hokodo will be collecting from the buyer 30 or 60 days later. So that's the basic flow of funds. It's important to highlight that, you know, even if the end customer doesn't pay in the these 60 days later, the merchant keeps the money. So the whole transaction is covered, protected by Hokodo against the risks of non-payment, which simplifies all the credit management, turning, chasing process for the merchant.
Yeah, yeah. And it's really interesting. So you talk about the model there of a business buyer or a business buying directly from a merchant. But you know what we've seen is this you know, the world of marketplaces is growing rapidly. I think it's about 10% of e-commerce at the moment in Europe is actually comes from these kind of marketplaces. And this is a bit more of a complicated model, right? You have the marketplace, the sellers on the marketplace platform, and then you've got the buyers. How does that impact the process of the payments flow?
Right. Yeah. There, I went for the base case of a regular merchant of record selling to a customer. Let's say that the end customer experience doesn't change at all from what I described in the context of a marketplace. So the end customer, you know, might not even know that they're on a marketplace. In some cases, they come to the website, they make their purchases, get their payment terms, and then settle with Hokodo. While Hokodo, and that's where it differs, we send the money to the marketplace with the central orchestrator there. And there's one additional step that needs to take place in the context of the marketplace, which is the splits and payouts, where the marketplace gets the pay-ins from Hokodo and then still has to allocate it to the various suppliers and take their commission. And this extra step, it doesn't really change whether, you know, the pay-in is coming from Hokodo or another payment method. There's always this extra step that needs to take place for a marketplace. Yeah.
Okay, that's really interesting. There's one thing that you said there that I just very quickly, I know this not the core message of what we're talking about today, but you mentioned the words merchant of record. Can you just kind of explain a little bit about that in terms of a marketplace, what that means?
Yeah. So most marketplaces are not the merchants of record, meaning that they don't take ownership of the goods, and they play the role of an intermediary between the suppliers and the buyers. So the merchant of records are the suppliers on the marketplace who sell to the buyers. The transaction is facilitated by the marketplace, who takes a commission, but the marketplace doesn't take the goods on its balance sheet. Some marketplaces do and have made that choice, but I think it's a minority of them. 3/4 of the marketplaces that we meet and work with tend to be pure intermediaries.
Yeah. Okay. Fantastic. Thank you for explaining that. And then you mentioned there about something that was really, really important, where you said that you know, in those circumstances, whether it's a marketplace or a direct merchant, but that buyer experience is still the same. So, you know, what does that buyer experience look like? Like, what payment methods can they, how can they pay Hokodo back? You know, how does their experience look?
Yes, so I think the crux of the matter is, how do you bring the best payment plans to the end customers, along with the best settlement methods? And that's what will allow you as a merchant or a marketplace to drive the maximum customer satisfaction and increase the conversion rates, you know, at your checkout. And to do this, we tend to work very closely with the merchants to test different payment plans, like, you know, pay in 30 days, 30-day end of months, in 3 installments, to try and find the ones that give you the best value for money. And then once a customer has checked out, chosen that they wanted to pay on 60-day terms, then the following step is to say, to choose the settlement method. And by that, I mean credit cards, direct debit, bank transfers. So especially in B2B, where as you said, the average order value is typically much higher than in B2C. You won't be settling a £10,000 or euro purchase with a credit card. So it often then becomes a bank transfer or a direct debit. And at Hokodo, we support all those settlement methods, again, with the end objective of delivering the best purchasing experience and combining the best payment plans with the most optimized settlement methods.
Absolutely. It is very it's scary, isn't it? How many businesses, and, you know, as a business ourselves, obviously we make kind of purchases through, you know, through other businesses, and in our own personal lives, you can make that very, very quick payment transaction. Or if you was to use a kind of a buy now, pay later service, it's all very slick. But yeah, in the world of B2B, it's I'll send you an invoice via email and, you know, and then forward that to your finance department.
And turning that process into something slick and enjoyable, which, you know, even for the B2B, the professional buyer becomes, you know, at the same level in terms of UX and everything as what we get in our personal lives, is what this is all about. And we see more and more e-commerce platforms, marketplaces, who really place payments at the core of their strategy, because that's how you monetize, drive loyalty from your customers, and ultimately capture more share of wallet. Yeah. So this has moved in terms of the agenda from, you know, the back office of the finance department, where, you know, trade credit was often relegated, to a core element of the value proposition and of the UX, of the user experience on in the checkout.
Yeah, absolutely. Self-service buying.
Yeah.
It's never that simple, though, I hate to say. And, you know, there's always those kinds of edge cases, aren't there, where, you know, there's a refund that's needed, or, you know, there's a dispute, or there's a chargeback. So, you know, what happens in those cases?
Yeah, there's always the nice happy case where, you know, the customer pays on time after 30 days and so on. I think what's needed is you know, a very strong set of APIs and processes to be able to deal with all those edge cases. And I think I tend to place those edge cases in two different buckets. There's one group where you have, like, you know, all the refunds, cancellations, partial refunds, returns, which are an integral part of doing business. You have it offline or online, and, you know, this is actually part of the user experience. And you want to deliver something that's, you know, just very smooth, but also very scalable. I think for us, depending a bit on the merchants that we serve, we tend to see rates of refunds that are between 1% and 3% of the total GMV. And, you know, when you have thousands of orders, that does build up. And that's why you need a set of post-sale APIs that allow you to deal with those cases. But it's, you know, it's very, very simple. If we take a very concrete example of someone who makes a £1,000 purchase on the website, you know, on Monday, then we will send, as I mentioned before, in the flow of funds, Hokodo will send £1,000 to the merchant, and let's say 1 week later, there's a refund. The customer doesn't want half of the goods or whatever, then the merchant tells us via API that half of the order is cancelled, and therefore the order moves from being 1,000 to £500. Then in 30 days, or whenever the due date is, instead of capturing 1,000 from the customer, we'll just charge 500 at that point. So to the customer, totally seamless and, you know, and they don't have to do anything different. And then what happens between Hokodo and the merchant is there again very classic, and no surprises. It's that, so we sent 1,000 to the merchant, but in fact the order ends up being 500. So what we do is that in the next payout that we would make to the merchant, instead of and let's assume for the sake of the example, the next payout was going to be £10,000 the following day or the following week, we will subtract £500 to net off that cancellation. So instead of sending £10,000 the week after, we'll send 9,500 to account for the 500 too many that we had given the week before. So that's, and all this is managed automatically. And for this, I'd say scalability and automation is the key, because we want to help the merchants have a super efficient back office. And also for our own operations, we want to minimize the back and forth. So that's bucket one of the edge cases. And there's another bucket where you have all the edge cases that are around impersonations, account takeovers, chargebacks, so other non-payment cases that they come in dozens of flavors. And this is where number one, the role is our mission is to protect the merchant. Whenever there's a chargeback or fraud, or in any case, the merchant is protected by Hokodo. So there's no clawback in the flow of funds. We sent £1,000 to the merchant for that purchase. If there's a chargeback, the merchant still gets to keep the £1,000, and Hokodo takes the loss and insures it. And we reinsure it with Lloyd's of London in the background. But that's the same for any other type of loss. And this is really key. And a few months ago, when we started working with the merchants, they had a high volume retail website that was hammered by fraud cases, and working with them and helping them curate their buyer bases to restore the trust in the platform, guarantee to the sellers, to the suppliers, that they would be paid no matter what. And it was absolutely fundamental, because frauds can escalate very, very quickly in e-commerce. When fraudsters identify a crack, they just double down, and then the losses can pile up very quickly. And it's often this 1% or 0.1% of bad transactions, fraudulent transactions, that can really kill the economics for the 99.9% of the population that are just transacting normally. And it's just like when you have a very, very bad driver in insurance, sometimes you want to exclude them from the insurance scheme, because otherwise everyone has to pay a higher premium.
Yeah, that's a great analogy. And it's really interesting what you were saying about, you kept repeating kind of about it all being completely automated, which is absolutely key, right? Because I'm sitting here kind of imagining that scenario as you were talking, and the correspondence or the communication that needs to happen between all those different departments, and lots of emails flying around. And, it's it can't be managed.
And the tools to orchestrate all those different steps, from the trade credit process, from credit checks, fraud detection, collections, they have really changed over the last 15-20 years. The level of digitization, automation that you now have in the back office is night and day compared with what we had in the early days of e-commerce. But you still have lots of credit departments, lots of finance departments that are still operating collections manually, with John following up on customers, or finding that the person was not who they thought they were, and so on and so forth. And it's really hard when when your business is dedicated to food and beverages or construction to invest in the infrastructure for fraud detection, for automated credit scoring that allows you to really get to the next level, not only of risk management, but ultimately of user experience. Because all those things, they translate into user experience. And we're in payments at the end of the day, where if you have an acceptance rate of 50, 60, 70%, which is what we've seen historically in trade credit, well, that's actually pretty low compared with the the benchmarks of what is a good online experience, where people would expect at least 80% of acceptance rate. So how do you get to that level? How do you get to that level within a single second? Because every second of delay will cost you 7 percentage points in conversion. This is how you do that jump that will ultimately drive the customer satisfaction, hence the loyalty, and hence the repeat. Yeah. Many people are focused on trade credit will give me more a higher basket size, a higher conversion. True, but the real gem is actually in the loyalty and the repeat, and having a customer who comes back to your website to procure.
Absolutely, yeah. And key to all of that, obviously, as you've said, is that kind of integration between all of the systems. So can we talk about that a little bit? How is Hokodo integrating with some of those key systems at the checkout?
So typically we'll be integrated in the checkout of a merchant. So either through direct API integration, most of the time takes less than 20 hours to engineering teams to integrate us. If we also have plugins for Magento or Shopify, which will make it even faster to integrate with us. And if you picture a typical checkout where you have the different payment methods, right? The credit card, the PayPal, the Amazon Pay, then many merchants choose to have another button that they call the pay in 30 days or pay later or pay on trade account. That's one version of organizing the checkout. And that triggers a series of API calls between the merchant and Hokodo. And yeah, that's roughly how it works, like integrating another payment method.
What happens though if they have if the merchant has an offline sales channel as well? So they have everything online. Yeah, it's really great. It's all very kind of seamless. But then you have a customer that does want to continue to order over the phone. You don't want them having a completely different experience, right?
Yeah, absolutely. And we actually have many merchants who have the offline channel as well. So some use us just for the online, some use us both for the online and offline experience, where oftentimes, as you say, the key accounts will also order online. So imagine an experience where the customer rings a sales rep, and the sales rep then closes the sale on the phone. And by the way, knowing that they can offer payment terms will allow them to close the deal much faster. So that's also part of the offer. We will integrate in the sales system or the CRM, and the sales rep, as they're on the phone with our customer, will see that customer Joe Bloggs Ltd is eligible to 60-day payment terms for a credit limit of up to £20,000 or euros, whatever. And they know that they can offer payment terms straight off the bat, and they will send a payment link or an invoice with a payment link to the end customer. The end customer clicks on that payment link, then they have their 60-day payment plan. And again, back to what we were saying earlier, they can choose to pay by direct debit, bank transfer, credit card if it's a slow amount. And off we go. That's trade credit as a service.
Easy, sounds easy. So we've talked a lot about trade credit, and I mentioned at the start about, in the world of B2B, you've got, 80-90% of all trade worldwide is facilitated by trade credit. But obviously there's still that kind of 10 to 20% then that isn't credit. People want to pay now, they want to pay immediately. So tell me a little bit about that. How does that work?
Yes, you have that interplay between pay now and pay later. Well, actually, very few people want to pay now, but especially in B2B, where in fact what we see is an expectation to have payment terms, because that's how we've always traded. But having pay now and pay later side by side is actually really useful. And now, as a payment institution, Hokodo does offer the two streams, and because it answers a question that our merchants were asking us, which was, hey, we really like Hokodo, we love it that you give payment terms to 90% of our clients. That's the best payment method. But what do we do with the remaining 10%, the ones that are not eligible to payment terms? Because these companies are new or not financially solid. Well, then we're able to then process that payment through a pay now method. And where the interplay is really interesting is that once you've built that level of confidence with a customer, because sometimes you suspect a fraud or something like that, make them pay up front. Make them show you that it's a legit transaction. See how it's going, and next time maybe you offer pay later with a small limit. Or another use case is, imagine you have a credit limit of 10,000 euros on a buyer, and the buyer wants to check out for a total purchase of 12,000. Well, then what you can do instead of rejecting that transaction is, okay, let's process 2,000 euros upfront and 10,000 euros later. So it's that flexibility and that complementarity between pay now and pay later that allows ultimately for the best experiences.
And how is the buyer paying now? Like, what methods? Is it the same methods that you mentioned before?
Yeah. Then, if we dive into it, there will be some intricacies. For instance, in some sectors where you need a very fast payment because the order needs to be shipped in the same day, like sometimes in food and beverage, or in automotive where it's for car repairs. Then a bank transfer is not going to be very convenient, because it only shows up the next day. So then in that case, a credit card can do the trick. But when it's not, you don't have that same need, and you can wait for a day, then bank transfer becomes again an option. Yeah.
And I love what you said actually about that kind of, building trust with the between the merchant and the buyer as well, about using that kind of pay now. And I also see it the other way around, to be honest with you as well, because the business buyer might actually want to try out the kind of the pay now method, with Hokodo, for example, and the merchant, to kind of see what the experience is like before they enter into kind of more of a committed sort of trade credit agreement or something. So yeah, it kind of works both ways. I really like that. Okay. Yep. Fantastic. All right. Well, thank you. We've come up to time. These things always just whiz
by. Time flies.
Exactly. Thank you very much for being my expert for the day. Very, very interesting. And I hope the audience really enjoyed it. So thank you for joining.
Thank you, everyone.
Bye.